Today, we have Mohammed Hassin from Balanced Asset Solutions. He's been doing this for property managers for over 15 years now, and he is going to talk to us about are we audit ready, especially from a property management point of view. Just like all other webinars, this webinar we make it 30 minutes just so we can get people in and out. We know everybody's day is super busy. So with no further ado, Mohammed, you are up, man.
Beautiful. Thank you for that warm introduction, Pete. I'm happy to be here. Hello, everyone. My name is Mohammed Mo Hussein. I'll be your presenter today, and we get to talk about the wonderful and exciting topic of audits. Are you audit ready?
Run. No, I'm kidding.
Steps and to avoid pitfalls and ensure compliance. So as I'm going through the presentation here, Pete is generous enough to be able to check on any questions. So if you have any questions, feel free to add it in the Q&A. You can also raise your hand if I see that as I'm going through particular topics. I will take a pause if it's related to the topic. If not, I may save it for the end, and we'll have some time at the end to do some Q&A. So today's agenda, we'll talk a little bit about what GAAP compliance is, the role of trust accounting, strategies to conduct self-reviews and things you need to kind of look for in preparing for an audit, and how you can leverage your software for compliance. And then we'll leave some time at the end again for some Q&A. So let's go ahead and get started. So today's goal from a high level is to provide insight into my experience and our organization's experience on kind of going through audits. We've been around for a little over 8.5 years. I've been in this industry for close to 15 years and work with clients all throughout the U.S. We're a CPA and accounting firm and constantly are working with clients that are going through Department of Real Estate audits. And so today we're hoping to provide some information, collateral, and tools to equip you with the necessary information and knowledge to ensure that you are audit ready. Why audits matter. So a lot of folks in this industry usually start off as a broker, buying, selling real estate on behalf of your clients, and usually over time, a client or two may ask you to actually manage their real estate and their actual portfolio from a property management perspective, and that's where we see a lot of folks kind of jump into property management. Property management does have kind of strict certain compliance and rules depending on the state that you're in. I'm sitting here in the state of California, which is very strict in terms of like trust accounting. But in general, audits are usually kind of an afterthought. It's similar to kind of insurance. You want to make sure that you have it and you are ready in the instance where you do get called up. What we see is usually folks that are being audited. There's usually one of three reasons that an audit is kind of triggered. Keep in mind, in the U.S. alone, there's probably close to a little over 220,000 different management companies. There's no similar size of an army with the Department of Real Estate that's technically able to audit everybody. And so usually there's three kind of like cues that the Department of Real Estate will get on an organization that they're looking to audit. It's a disgruntled owner that wasn't receiving reporting or accurate financials that gave an anonymous tip. There's a disgruntled tenant that doesn't feel like their maintenance requests or that their concerns are being heard by their management company, or when it comes to fair housing prospects. And so I always say that
I'll give you a fourth one, Mo. I'll give you a
go
fourth one.
ahead.
Another agent or broker that's unhappy.
There
They'll,
you go.
even though they're not supposed to, we've seen that from time
That's
to time.
right. That's right. That's right. So this goes back to, one of the fundamental concepts in business and just like communication and, the adage of like karma, what goes around kind of comes around. You want to make sure that, you're running your business in a manner that's, fairly ethical, and that you are working with people in a very fair manner. Audits are very, very business disruptive, and failing these audits will definitely put risk and potentially, you'll lose your actual your broker's license. When we look at just even the state of California, about on average per year, it's about 5% of companies. There's close to about 50,000 management companies headquartered in the state of California. About 5% are audited yearly. So it's not a matter of if, it's a matter of when. So 1 out of 20 companies are being audited each year. Audits, if you're using a third-party firm, usually cost somewhere ballpark about $25,000. However, the typical fine is somewhere to the ballpark of about $35,000. And these range. We've seen audit, fines from, a couple $1,000s up to, well into the six figures, depending on how egregious the violations are. And I'll talk through some of those as we go through our presentation here. Excuse me, I keep going back. Next, we'll talk about understanding GAAP compliance. So GAAP stands for Generally Accepted Accounting Principles. In accounting, there's no such thing as creativity. If you have a creative accountant, I would be highly skeptical. There's always a right
Enron,
expense.
Enron.
And exactly. And actually, this is exactly why these standards were established. The generally accepted accounting principles, what's known as GAAP, was established by the Financial Accounting Standards Board, FASB, and there's one for the government also. And these organizations were put together after Enron, the whole Enron scandal. So there's no such thing as creative accounting. There's always a right answer. And the whole point of GAAP is to standardize the way that financial reporting and information is shared with investors, with stakeholders, and with the general public. This ensures that there is cohesive kind of consistency across, reading and understanding kind of financial reports. Talked about GAAP compliance. Within the real estate industry, we have, within the real estate industry, we have what's called trust accounting compliance. Before I go into that, I forgot to have the slide on GAAP. So for those of you that don't understand GAAP, there's kind of three main components to it. You have revenue recognition, which is, ensuring that revenue is recognized when it is earned. So for example, in the beginning of the month, the first of the month, when a tenant pays rent, that is when rent revenue is recognized. If they pay rent the day before the first of the month, that is technically a liability. That's what's called prepaid rent, right? So ensuring that you're recognizing revenue when it is actually earned. It's different for both cash and accrual basis. You have what's called expense matching, which is aligning the expenses with the revenues that are generated in that same period. And this ensures that there's a corresponding revenue for each expense. And then the iconic canonical kind of financial statements, the big three, what we call the balance sheet, the income statement, and the cash flow. And this ensures that, all these different financial reports are reported in a cohesive kind of manner. Next, we'll talk a little bit about trust accounting. So within within real estate, you are, and it's not even only just real estate, it's just the scenario of where you're working and touching other people's money, other people's assets on their behalf. It's what's called trust accounting. You're managing funds on behalf of a client. There's some core tenets that you need to kind of take into consideration. One is it needs to be separated away from your business operational funds. So you as a corporate company, your property management business, your brokerage business, that needs to be separated away from what are called your trust funds. Your trust funds is the accounting and also the monies associated with the operations of the properties that you are managing on behalf of your owners or even entities, okay? This is the main reason that the Department of Real Estate exists, is to ensure that owners are protected and that, they're not taken kind of advantage of, if you will, by management companies, but also additionally that the management companies are managing their funds correctly and in a compliant manner. Strict adherence to this is very important, and violations like, commingling things like security deposits or commingling funds between your corporate and your trust accounting carry very heavy penalties. And sometimes, usually, if you get audited, if you do not pass the first audit, the Department of Real Estate will definitely circle back, usually within 18 months' time, and the penalties will continue to increase if you continue to kind of fail on those. Next, we'll talk about the importance of best practices when it comes to kind of trust accounting. So there's three main kind of tenets you want to kind of keep in mind. One is fund segregation. Again, that's kind of you should have a separate bank account for your corporate entity than that of what is associated with your trust accounting.
Oh, we have a question here real quick. Do you
Yep.
recommend having a separate bank account for security deposits versus rental or the owner accounts?
Good question. So this would be the operating funds versus the security deposits, which are considered kind of a liability, if you will. So the Department of Real Estate doesn't really stipulate how many different bank accounts you have. We've seen multiple different types of setup. You can have a separate bank account for every single owner that has both their security deposit and the operating funds. You can have one operating funds that's an aggregate of all your clients' properties and owners for the operating, and then a separate one for the security deposit. Or we've also seen scenarios where every single property has its own operating account and its own security deposit account. And so the Department of Real Estate doesn't really dictate which setup that you can have, but there's a couple things to kind of keep into consideration is that in instances where you want to commingle like your security deposits, for example, with your operating funds in the same bank account, ideally what you should have is at least what's called two different cash accounts. So you should have an operating cash account and a security deposit cash account. And so think about if you have one bank account for all your clients, think about it as a pie. You can split that between operating funds and the security deposit. That is completely fine. You just need to make sure that you're following proper accounting and that you're constantly doing a check and a reconciliation at the end of the month to ensure that you have enough funds in the security deposit cash account as you have in your liability account, your liability balance, which show up on your balance sheet, also what is showing on the actual tenant level liability. If you have separate bank accounts for every single property and have separate, operating and security deposit, it makes it very difficult for you to potentially, have scenarios where you steal from Bob to pay Bill and things of that sort. However, having more and more bank accounts increases the amount of bank accounts and additional accounts you need to consider on kind of a monthly basis. So it's kind of a trade-off, right? Ideally, we always suggest to our clients that you should to keep things simple, it's best to have as little number of bank accounts to reconcile as possible. But in that scenario, you need to make sure you have the right, especially like accounting systems, to be able to segregate or show that segregation of funds on a per owner basis. If you have one bank account that's housing all your owners' properties and operations, you need to make sure you don't dip a property into a negative balance because that bank account is shared across multiple other owners. If you dip a property to a negative balance, that check or that payment won't necessarily bounce because you're stealing from another property's funds, another owner's funds. And this is a very important concept, especially in certain states like California, where like the Department of Real Estate is very strict about this. Even if you have an owner that has multiple properties and one property is at a negative balance and another property is at a positive balance, you can't just take the net and figure out what payments go out to vendors or owners or distributions. You should move funds from the property that has a positive balance to cover the balance on the property that has a negative balance. So then that way, all properties are always showing at least a balance of zero, if not more. Good question, though. Bank reconciliations. This is something that you should be doing on a monthly basis, and there should be some compliance and kind of oversight on this. You want to make sure that some of these accounting systems do a really good job of what's called like tying out the trust account, which is the property cash balances to the balance that's in the bank account. And so ideally, if in some scenario, all your owners wanted to cancel their agreements with you and you need to hand back the funds associated with all your properties, there should be enough funds in the bank account to be able to pay back the cash balances on all the properties and cover any uncleared items, okay? Detailed record keeping is
Got
also
another
very.
question here, Mo, real quick.
Yeah.
What day of the month should you have all your reconciliations done by? Is there like a standard operating procedure or something that you like or that you guys determine what's best?
Yeah, great question. So usually what we suggest is as of the end of the month, the last day of the month, you should, and most of these accounting systems like AppFolio, and you already allow for you to be able to have what's called a soft close, so that all transactions from the prior month are kind of not locked in, but at least not give you the ability to backdate transactions. Now, user permissions and stuff will give you some of that flexibility. Ideally, you want to make sure that you're entering transactions kind of in real time. This is something and a point that is very easy to kind of overlook. You may have auto payments that are coming out of the bank account and things of that sort, but it's very key that you use your accounting system as your guide on understanding everything that's happening and that is being updated kind of in real time. So rather than looking at your bank account consistently, you just need to look at the trust account balance and the balances on the properties that you are managing. And so ideally you should have the bank reconciliations completed ahead of doing owner distributions. We usually suggest owner distributions usually be done on the third week of the month. The reason for that is usually the first week of the month, you're getting tenant payments, applying late fees. Maybe there's some move-ins and some move-outs. The second week, you should be paying off vendors, the invoices for any, work orders, things of that sort, then your management fees, and then your owner distributions. Before you do your owner distributions, you want to do your bank reconciliations, do a review of all the financial reports, including the bank reconciliation, the big three reports, which is the balance sheet, income statement, and cash flow on a per property basis. And then when you send out your owner distributions, like all that reporting and everything should be locked in, and all that should be validated, and the month should be closed out. Usually for us, we close out books at the latest by the 17th of the next month. So, in 2 days, we'll be done with the accounting and all the bank recs and everything for our clients as of, for the end of February. Good question. So the purpose of trust accounting. So one is I think I actually went over this slide. Maybe I might be going backwards. This is just a great visualization to show on kind of best practices. So again, fund segregation, regular reconciliations, detailed record keeping, and having these things will help ensure that you don't commingle funds. There's inadequate documentation and infrequent bank reconciliations, and then you have the benefits of compliance, protection of client funds, and enhanced trust and transparency. Next, so we've talked about GAAP compliance, what the role of trust accounting is. Next, we'll talk a little bit about conducting your self-reviews. So, nobody wants to go through an audit, but the matter of fact is that they do kind of come up. And so this is something that you should be consistently kind of prepared for, if you will, in the instance where you are called up for an audit. We suggest that you should be doing an internal audit at least on a monthly basis, if not on a quarterly basis. And it should be tasked with a team that is not doing the accounting. You can hire a third-party company like ourselves to conduct that for you, or you have another team within your organization and have a check and balance between the folks that are doing the accounting and also the folks that are doing kind of the audit. A lot of these property management companies have built-in features and reports that allow for you to be able to easily surface up the information that you need to kind of review during your audit process. Appfolio does a particularly good job on having audit logs and bank activity report, financial diagnostics. You want to embrace, automation. So, a lot of these software companies have different kind of controls, if you will, and role-based access, and the ability to prevent things like, or having kind of review process, for example, on like AP to ensure that they're coded correctly. And you're not hitting things like liability accounts, like a security deposit account during like a move out, for example. That should be hitting a clearing account. And so, instituting and kind of implementing these controls and having kind of strict SOPs on how things are done within the organization will also help ensure that you're in a constant kind of compliance status. Going through kind of a self-audit. These are kind of the steps that we suggest and implore our clients to do is, set objectives and assemble a team. Gather, there's a set of documents that need to be kind of gathered, your financial statements, bank reconciliations, trust account records, and even lease agreements and contracts. You should review financial transactions, that revenue is properly being recognized, that expenses are being properly matched, that the trust accounts are segregated, if you will, and that there's regular reconciliations done, and then that the transactions that are showing up on the properties are all correct, accurate. You want to ensure that things like your reporting adheres to generally accepted accounting principles. You should be doing kind of spot discrepancies to see if there are any errors. And then when there is an error that's recognized, you should figure out what the kind of the root cause is of that particular error, and then document that error and that correction and establish it as part of your audit kind of SOPs. Evaluating internal controls. This is something that is very much kind of overlooked, and we see this a lot with clients when, unfortunately, this industry is somewhat notorious for things like embezzlement happening. It is not uncommon. If you have, wide-ranging access that your users have across the org, And this includes even folks that are like the CFO and whatnot. They shouldn't be able to, create new properties or create fictitious properties or fictitious bank accounts and what have you that are tied to real bank accounts. It's very easy with these new software or just software options and what's available out there to give kind of wide ranging access and not be able to identify when there's like negative or kind of concerning activity and stuff that's happening. We had a client a few years back who was going through an audit, and unfortunately, their CFO had disappeared a couple weeks before the audit that was coming. They had reached out to us, and when we were doing our forensic accounting analysis, what we saw was that there was fictitious properties that were created in the client's database, and those properties were tied to the same trust account, the bank account that they're housing their owner's funds. And this individual was writing checks to themselves and to entities, and they were essentially embezzling money out of the account. However, they were overseeing the bank reconciliation process, and so they were creating adjustments. And so their executives were getting these reports and not seeing like, hey, any foul play or anything until they went through a hard audit by the Department of Real Estate, who looked at their actual liability balances and what they actually had in their bank account. They're showing a shortage of close to $350,000.
Oh,
This isn't a bespoke scenario. This is actually very, very common, and we see it a lot. Trust but verify, right? And this is just kind of like something the way you should approach business in general, right? And leveraging kind of a third party and having the right internal controls is very, very important. Things like if in your accounting system, folks that have the ability to create additional properties, to create bank accounts, to reconcile bank accounts, should also be checked in a manner, whether it's like externally or by another individual in the organization. And having these internal controls is very important. You should be putting together a summary report and developing kind of a plan to address these unresolved issues. This is our comprehensive checklist of all the kind of reports and financial and other information you should be taking a look at and kind of preparing for an audit. Again, we suggest kind of doing this on kind of a monthly basis, but at a minimum, you should be doing it on a quarterly basis. There's a lot to kind of unpack here, so I'll kind of quickly go through kind of the high level items. But we have, your financial statements, you have your bank reconciliations. You need to make sure that they are actually balanced. Simply checking off items that are on your bank account activity or on your bank statement is not enough to ensure that that is completed. You need to make sure that things like journal entries are not being used incorrectly. Journal entries should only be used when you have a bank fee, or you're logging depreciation or amortization or things of that sort. But if it's an actual payment that went out, including a mortgage, you should show that as a payable and as a payment. If it's revenue that's received, that should show as a receipt somewhere on a tenant ledger or another receipt and a deposit. You want to verify that your trust accounts are actually balanced, that your properties all have a positive balance. Revenue and expense verification, security deposits, that you're processing the tenant deposits correctly. Systems like iFolio do a really good job of bubbling up discrepancies in security deposits using a financial diagnostic report. Your bank account activity report should be able to reconcile activity and with that's on your properties with what is in your bank account. And then AR, AP, and then reviewing, of course, your internal controls, insurance or risk management, and then putting together that audit findings report. Main pitfalls that we see with folks that struggle: lapsed bank reconciliations. This needs to be done monthly. Once you're behind, time keeps going. And so you can't arbitrarily start on a bank rec. If you haven't done it for years or months, you can't just say, hey, I want to ignore what's happened in the past. Accounting is a building and a moving story. It builds off of the last month where it stopped. Commingling funds, unbalanced bank reconciliations. Systems like QuickBooks don't reconcile they don't recognize a property. And so it's best to use something like a property-based accounting system that will recognize the property and try to reconcile that with your actual bank account balance. Properties of negative balances, lack of doing a regular audit, and incorrect handling of security deposits. In some states like California, if you don't return the deposit within 3 weeks, 21 days, you're liable to paying up to 3 times that. And then a lack of process and controls. Preparing for an audit. Auditors are just like you and I, people. They usually will look at things from a very high surface level. So they'll ask for just maybe a handful of reports. And usually it's a couple of months worth of data. They may not ask for a general ledger, but they may ask for just your trust account balance, leasing agreements, agent agreements. They want to make sure that you have agents that are actually doing the work, the property management work, and bank account activity. Usually they'll start things at a high level and they'll sniff to see if there's something that's concerning. If there's something that's concerning, they will go deeper. And so maintain an open line of communication, very transparent, clearly articulate your process and controls, and be very prompt with your responsiveness. You know, from an auditor's impression and perspective, if you seem very organized, very prepared, and even in instances, if you are working with a third-party accounting firm that specializes in audits, it gives a lot of confidence to the auditor that, okay, you know, I probably don't have to dig any deeper. Leveraging software. So a lot of these software products have, you know, different features and reports that allow for you to be able to see compliance and ensure that things are in order. So AppFolio has a great report called the Financial Diagnostic. It bubbles up things like bank recs that are very lapsed, you know, security deposit, clearing accounts that have a non-zero balance. And then errors and like escrow mismatches. You want to regularly review audit logs. I would suggest, you know, nixing the ability for any users within your database to be able to create things like bank adjustments. A bank adjustment is exactly how it sounds. It's an adjustment, a Band-Aid, if you will. And then, as I mentioned before, you know, insuring properties in your trust account that don't have negative balances, security deposit funds, and that you're reconciling your balance sheet. And that, you know, you should be reviewing also your bank reconciliation report. There shouldn't be any deposits that are over 30 days old. It doesn't take 30 days or more for a deposit to clear your bank account. If there are any positive items outstanding that haven't cleared on your bank reconciliation report, this is particularly concerning because you are artificially increasing the balances of your properties and it's not clearing the bank account. And that balance is used to derive the balances that you're sharing with the owners, how distributions are calculated as well. Preparing for an audit, use the software programs that you're using. You can work with a third-party firm like ourselves, but make sure that you have kind of a process kind of in place. You know, minimize and reduce human risk by using some automation. We've created bots and stuff to help with like automating kind of compliance things and doing things like bank reconciliations. But leveraging the software and controls and automation is usually going to free up time for the organization so that when, you know, in the instance where there is an audit that starts, it's not a crazy big shuffle and scramble in the organization. And ideally, you know, these systems, if they are used correctly, will ensure kind of long-term compliance. At the end of the day, last thing I'll leave you off with is, you know, the software companies that you may be using, you know, reaching out to AppFolio or whoever software you're using, they're not an auditor, they're not an accountant, they are a software company. They are not there to give you accounting advice. And so please be careful and be cognizant, you know, reaching out to your software provider to understand how to enter an account, an accounting transaction or understanding a financial report. That is not their forte, and the feedback and advice they're going to be giving you is from the perspective and lens of IT and technical support to ensure the product is working correctly versus, you know, the accounting implications. So I know I zoomed through that quite a bit, but just to hit our kind of timeline here, and we have a couple more minutes.
We
Pete,
got a couple of questions here, Mo. So let me throw them out here. If able to say it, what are the top three PM software platforms that are most quote unquote friendly in regards to the content presented today?
I try to stay away from, you know, making subjective type of comments and try to keep things very objective. I will say that, you know, in the SMB space or like small to mid-sized space, when I say that, you know, clients with a couple hundred units up to a couple of thousand, the platform that we see that's very friendly, if you will, and very easy to kind of use and bubble up compliance information and audit is AppFolio. I would say AppFolio, Breeze Premier, Yardi's SMB product. There are other products that are in the space like Rent Manager, Buildium, Propertyware. But I will say that, you know, over 80% of the audits that we work on are clients that are using those products. Buildium, Rent Manager, and Propertyware do not have as good of a kind of audit trail, controls, and just reporting that ensures kind of compliance. It doesn't mean that you can't be compliant using those products. It's just going to take a little bit more work, if you will.
Couple other ones here. How often should I do a self audit?
Good question. So you should have a monthly closeout process, monthly accounting closeout process that you should incorporate your self audit during that same monthly kind of closeout process, ideally. If not, do it in a quarterly basis, but probably highly suggest not doing it annually because it's way too much information and reviewing way too many bank reconciliations. And so ideally, do it on a monthly basis.
Is there any type of AI solution to do a self audit?
That is a good question. That's something that we've been kind of pioneering and kind of figuring out. But usually what we see when we see issues associated with kind of compliance and audit kind of violations, it's human error. And so using AI to kind of automate and kind of have controls on how things are done, like we have a bank reconciliation bot, for example, that some of our clients kind of use. But I would say that there isn't a solution that's out there today that's completely, foolproof, if you will, and just deploy it into an audit. Although, we're particularly trying to work on a solution similar to that, but I think we're still a little ways away.
Yeah, everybody's got AI on the brain these days. That's for
That's
sure.
right.
Sure. Um, all right, let's see. I think. Oh, where do you come out on positive pay? You a big fan, or does it kind of hinder?
Yeah, so positive pay is usually banks will kind of use positive pay for what's for like approving or letting them know what checks were cut. So they don't unclear or they don't reject those checks. I think positive pay is it's a great check item, or lack of better words, or pun intended. It's a great item to have control over payments that are going out. I wouldn't necessarily say that it's a mechanism used for compliance when it comes to trust accounting or GAAP. It's more of a control when it comes to payments that are going out. Here's what I will comment is most of these software companies, especially companies like Appfolio, and you already have what's called like approval workflows. And so rather than having to send the bank like, hey, I cut a check 1006, make sure it doesn't bounce, you can have that approval workflow start at the time that the invoice is being approved, even before the payment is made, negating the reason to have to do that additional work of reconciling the transactions that you created with your bank. And so again, I think it's a great tool for control on payments that are going out. Although I feel like you can have that control at the point of when the invoice is created and approved. And so from our perspective, it seems a little bit like it's redundant and there's additional work there that's not really fruitful if you're using the right software and already have an approval process.
All right, thanks so much, Mo. If anybody has any other questions, feel free to throw them into the chat. Next month, we're going to be talking to Lior with Blanket on how to go from rent collector. I like actually saying how to go from property manager to asset manager. So if you click on the QR code here, go for it, and you can go ahead and schedule for our next webinar, which is Tuesday, May 13th, same time. I know we try to make them 23 minutes, but we're going about 30 minutes these days. And if you want to hire a remote team member that can do some of these bookkeeping items, feel free to click on here and do our white glove service or our gold glove service. We appreciate you guys being here. Thank you so much. And let's see, last check for questions. No other questions. Feel free to raise your hand. All right, we're going to go ahead and end this now. But if you want to stay on and ask a question, feel free to do that. Mo, thanks so much for being here.
All right.
Really appreciate you taking the time out of your day to educate some of our folks.
Pleasure to be here, and shameless plug, if there's any questions or any of you that may need help with an audit or establishing that process internally or need any kind of accounting CFO services, you can reach us at www.balancedasset solutions.com.
All right, thanks everybody. Hey, Mo.
Thank you.